Listen up, because in this video, I'm going to teach you how not to be an idiot, which is not a simple thing to do, not because you're special, not because you're a unique snowflake. It's because we as humans are programmed to be idiots. We are governed by our emotions, and that is what's leading to 99% of mistakes being done with people's portfolios. Now, much like car accident, most of these mistakes, most of these losses can be avoided and are caused by human error, our own. And in this video, I'm going to share with you some of my stupidity in the past that taught me how to avoid these mental and emotional mistakes. Now, I don't want you to click nothing. Don't want you to smash nothing. Don't buy nothing. I don't know courses, no sponsorships. Just listen up, because this is important and hopefully it will help some of you. Now, the first thing I want to talk to you about is FOMO, fear of missing out. Chasing FOMO is one of the worst things you can do as an investor. A good example is what's happening with Palantir over the last few days. Now, I'm sure some of you were not listening to the hype around Palantir and stayed out. And now the stock price is rising, it's going ballistic every single day, and you fear of missing out. So a lot of people will jump on it today or maybe even tomorrow because they don't want to miss out on the big hype. And that's a huge mistake. I'm not saying that getting Palantir stock is a huge mistake. I'm just saying that getting it out of FOMO, that's the huge mistake. A smart man once told me, if you're just buying stock out of the expectation that somebody will buy it from you at a higher price, that's not usually a good investment strategy. And I completely agree. By the way, this wasn't told to me. It's a very famous saying, and some of you may actually know who said it. If you do, comment below. I wonder how many of you will know this. Now, I do have one rule. If I really want to get a stock, I have a 24-hour cool down. I can't get a stock until I wait 24 hours to let myself cool down, think clearly. And if 24 hours passes and I still really want it, then I can get it. Now, if you're a day trader, if you're a swing trader, that kind of strategy won't work for you. And that's why I'm saying that this video is completely irrelevant to swing traders and day traders. And if you're one of them, this video ain't for you. This video is intended for people who are into long-term investing, which means at least a year. I can even live with 6 months, but not less. And if you're operating in 6 months, 1 year, 2 year, 5 year periods, that extra 24 hours mean jack shit. They mean nothing to you whatsoever, but they can't prevent you from making a horrible mistake out of impulsive purchasing. Now, impulsive purchasing is part of our daily lives. We all did it. I mean, I bought this t-shirt. This was an impulsive purchase. I mean, some nostalgia. We have it every single day. But when you do it in the stock market, with the amounts of money that you have invested in the stock market, that's usually pretty painful. So give yourself 24 hours. And by the way, I have the same 24-hour rule on exit. If I want to sell a stock, I always wait 24 hours. And if I still want to sell it, then I'm going to sell it. I never do anything within the first 24 hours of wanting to do it. This cool down period is going to save your life. It's like counting to 10 when you really get pissed off. Same thing. It really works. Trust me. But then again, as you know, I'm not a financial advisor. I'm just a YouTuber with a system. The system worked for me. I'm sharing it with you. You work out your own system. It's okay to get inspired by me. You got to find something that works for you, with your needs, with your emotion, with your personality. Moving on. Now, the second strategy is not being a dumbass. Now, not being a dumbass is kind of general, but what am I talking about? It's not improvising. You got to walk into this with a plan, with a clear strategy of exactly what you want to do, what you want to achieve. You can't waltz into this portfolio basically saying, well, I'm going to do whatever. You got to have a plan. That plan starts with answering 3 simple questions. First of all, what is my financial position? How much money do I have to spend on this? Because this is an expenditure. I know a lot of people tell you this is investment, but if this is your last money, you need to pay bills, to pay rent. If it's not extra money, this shouldn't be in the stock market. It's just my opinion, but I feel very strongly about that. Less money, by definition, shouldn't be playing around in the stock market because there's a great risk. By putting money in stocks and bonds and ETFs, everything has risk. Ask the people in the 90s that thought that Enron would never go down, or the Titanic, or WorldCom, or Wirecard. Plenty of big-ass companies went belly up completely overnight. There's always risk. So the first thing is, how much extra money do I have to play around with? Now, the second question is how much time you got. If you're 60 and you're trying to work on your retirement plan, you probably have 5 to 7 years before you have to pull the money out. Pretty much. Let's say a decade. However, if you're an 18-year-old, 20-year-old, 25-year-old, that means you have good 35, 40 years to play with the money. Now, here's the other thing. You have to understand one simple question is what's your risk tolerance? I mean, how much guts or balls or whatever you want to call it you have for risk? Because that will determine the type of investments you're going to take. Cinderella, in case you haven't read the book, is basically a story when one girl had the perfect foot that was supposed to fit the perfect shoe. And once that happens, they lived happily ever after. The perfect story, the perfect ending. But in the stock market, that story has to happen for you to have a shot at basically weathering the storm because there's always a storm coming in the stock market. Just ask the people who basically been around for a couple of decades. There's always going to be bad, volatile times. And if you don't have the Cinderella story with your stocks, you're pretty much screwed. You're going to get jittery. You're going to get angry, antsy, and you're going to make mistakes. Because let's say you need money right now for rent or for food. So do you really want to sell out of a stock out of rent needs? Probably not. Or let's say you don't have 15 years to wait and you bought a biotech stock long term. What's the point? Or let's say you don't have volatility tolerance and you don't like risk and you bought something in, let's say again, biotech, which goes up and down, or cryptocurrency. You should match completely with your portfolio with the stocks that fit your profile because you got to be stoic. You got to be completely calm and collected when the storm hits you. Otherwise, you're going to sell off out of panic and you're going to miss out on this whole journey that's called long-term investing. And that's why I do encourage you to find your own answer to these three questions, because these three questions, how much time you want, how much tolerance for risk you have, how much extra money you have, will determine your success in the stock market way more than any due diligence or any YouTube video. Trust me. And now let's move on to the next mistake, which is actually very common, which I call gambler's mentality. If you have a gambler's mentality, you're going to lose in the stock market. And it's not necessarily what you think it is. When I say gambler's mentality, I don't mean swing trader or day trading. I mean a whole different thing. When you walk into a casino, statistically, mathematically, you know one thing. The longer you stay, the more probability you have of losing money. Every single game is skewed towards the house, whether it's by 1%, 1.5%, 0.5%. But the longer you stay, the odds even out and you lose. If you apply that kind of thought process to the stock market as a value long-term investor, you pretty much finished your own game. That's it. You can't do it because it goes against everything that is long-term value investing. Because long-term value investing is like marriage. Once you found the one, it's a keeper. You don't keep dating once you know the woman you want to marry with. Same thing with long-term value investing. The longer you stay in the market, as long as the fundamentals of the stock are good, the more probability you have of the stock going up, which is exactly inverse of how casino mentality works. That's why you have to be very patient and allow yourself the time to let the stock catch up with its fundamentals, much like Palantir is doing right now, for example. But there's other examples. Just be patient. Now, the next mistake is being a garbage collector. You'd be surprised how many people get confused between buying the dip and being a garbage collector. If you have a high conviction stock with great fundamentals, everything looks phenomenal, and yet the price is going down, like a Palantir, for example, for a long time, that's called buying the dip. But if you have a loser on your hands, don't buy the dip just to lower the average because you hope it somehow miraculously will go up. Didi, for example, when the Chinese government decided to perform an all-out on Didi, everybody kept saying to me, well, Tom, look at the stock price. It's so low. Yes, because the fundamentals are trash. The regulators are about to go bazooka on this company. There's no reason to keep buying just because it's cheaper. The only reason you buy the dip if you think the fundamentals are phenomenal and the market is making a mistake, which happens sometimes. But you gotta identify where the buying the dip differs from collecting garbage. Now, the next mistake I call doesn't matter, wasn't selling anyways. What do I mean by this? If your stock is having a bad day, you might get tempted to basically say, hey, I can't take this anymore. I had enough of this stock and sell it. Now, this is where exactly the previous rule, the 24-hour delay rule, would save your ass. But let's say you forgot about it. Let me remind you of a second rule. There's one thing you need to understand. If you had no intentions of selling that stock on that day, that little dip or a huge dip is just a virtual loss. Unless you sell it, you don't materialize it. It's just a number on a computer screen. However, if that's not the case and the fundamentals are great and the stock is just dropping because of panic selling, I personally wouldn't want to materialize the loss to make it real. Why? I'm just going to sit out, wait the storm, be stoic about it, wait until it goes back up, and just chill. I wasn't selling anyways today. Why do I care about the dip? But of course, circumstances can change and you have to look at the fundamentals. If there's any systemic risks, regulatory risk, something really nasty happened that the company was really hurt by, might be a good time to actually trim your position, but not just because of other people selling. Now, I hope this was helpful. Let me know below if you have any questions. If you have any tips you want to share with us, share below in the comment section. I'm sure a lot of the viewers would love to hear this. I'm going to try to go over every single comment. Can't make any promises. I'll do my best. Shout out to the people who sold me this shirt. This was an impulsive buy, by the way. I absolutely love it. I'll see you tomorrow.